Hello traders, welcome back to another episode of the free Smart Money Concepts course. Today, we are going to discuss two important concepts in SMC. These are liquidity voids and vacuum blocks. Liquidity void is a concept that I should have covered in my video on fair value gaps because these are very much related. But liquidity voids share similarities with vacuum blocks given how and when they are formed. So in this video, I will talk about liquidity voids and how they are different from a fair value gap. Then we will talk about vacuum blocks and their formation. We will also investigate the reasons why liquidity voids and vacuum blocks are formed on the charts. We will also look at the different types of liquidity voids and vacuum blocks. And finally, we will briefly discuss what to expect from these areas. This is going to be an interesting video, so watch the video till the end. And if you are benefiting from these series of video tutorials, make sure to give a thumbs up to show your love and support. Also make sure to subscribe to our channel to get the best trading education. So without wasting any time, let's get started. I have mentioned that fair value gaps and liquidity voids are related concepts. Let us understand this first. So if you have watched my video on fair value gaps and imbalances, you already know what this is. In that video, I have mentioned that after the price reaches a liquidity level and then reverses from it after sweeping the liquidity from that level, what will often come next is displacement. The fair value gaps are created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances are visualized on the chart by a 3-candle sequence containing one large middle candle whose bordering candles' upper and lower wicks do not overlap. So, a bullish fair value gap is a 3-candle pattern where the high of the first candle does not overlap with the low of the third candle, leaving a gap in between. Similarly, a bearish fair value gap is a 3-candle formation where the low of the first candle does not overlap or cross the high price of the third candle, thereby leaving an imbalance in between. In this definition, what you have missed is the term displacement. Displacements are nothing but liquidity voids. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as 2 or more strong candles that are all positioned in the same direction. These candles typically have large real bodies and very short wicks, suggesting very little disagreement between buyers and sellers. Or in other words, there exists an inefficiency in prices. Often, a displacement or liquidity void will occur just after a liquidity level has been breached and will often result in the creation of fair value gaps and a market structure shift. We can also think of displacements in relation to fair value gaps. At least 2 back-to-back fair value gaps will indicate a strong push in prices, resulting in a displacement. Usually, these liquidity voids or displacement moves form after a period of consolidation, and then the price suddenly moves up or down very strongly, printing one or more large-bodied candles. This means liquidity voids are areas on the price chart which is characterized by a lack of significant trading activity or volume. They typically occur after a rapid price movement, leaving behind a region in the chart where the trading was thin or almost non-existent. This phenomenon often happens because most market participants were not interested or were not able to trade at these levels, either due to a lack of perceived value or because the market moved too quickly for them to react. You can see this phenomenon every now and then across all different time frames. The peculiar thing about liquidity voids is that they almost always fill up. And by filling, I mean that the price will return to the origin of the void. The reason for this is that during the void formation, an imbalance or inefficiency is created in prices that has to be balanced. The erasure of this imbalance is what we call filling of the void. And while some liquidity voids waste no time in filling, some others take multiple periods before they get filled. Now let's take a look at bullish and bearish liquidity void formation. Here, you can observe how prices crash down from a consolidation area. The price formed a group of big bearish candles with large real bodies and little wicks as it moved lower. Clearly, the selling pressure is the dominant force here. There was literally no buying activity here. This means there is an inefficiency in the market. This is a typical case of sell-side imbalance and buy-side inefficiency, or in short, CB. I know I have asked you to relate CB and BC to fair value gaps, But the definition of CB and BC holds true for liquidity voids also. This means there were not enough buying transactions to counter the selling pressure, leading to a sell-side imbalance, and the lack in buying pressure remains as an inefficiency that needs to be filled. So we can expect the price to return back and fill this bearish liquidity void that was created. Do not expect the price to fill the inefficiency all at once. It will generally take time. At the first stage, we can expect the price to return back to fill the 50% of the liquidity void. Then it might come back again to fill the rest of the imbalance. So a typical example of this bearish liquidity void can be observed on the 1-month time frame of Nifty chart during the Corona crash. You can see two big candles crashing lower, generating an imbalance. But over the course of the next few months, you can see how the price returned back to mitigate the imbalance caused by the liquidity void. I won't be giving you any trade entry methods or strategies in this video. This is just a conceptual video to get your SMC basics right. We will talk about different strategies and risk management techniques in the second season of the SMC course. Anyways, in a similar manner, we can identify bullish liquidity voids. Here, you can see how the prices explosively moved up higher from an area of consolidation. As you can see, the price formed a group of big bullish candles with large real bodies and tiny wicks as it moved upwards. It is obvious that the buying pressure is the dominant force here. There was no effective selling activity to counter this price rally. This means there is an inefficiency in the market. This is a clear case of buy-side imbalance and sell-side inefficiency, or BC. What this means is that there are not enough sellers or selling transactions to counter the immense buying pressure, leading to a buy-side imbalance, and a lack in the selling pressure remains as an inefficiency in the market that needs to be mitigated. So we can expect the price to come back and fill this bullish liquidity void that was generated. As mentioned before, this void filling won't have to happen abruptly, but over time, these liquidity imbalances will be dealt with. If we draw a Fibonacci retracement containing only the 0%, 50% and 100% levels connecting the high and low of the liquidity void, then we can anticipate the price to fill at least till the 50% of the imbalance in the first stage. Eventually, the price will fill the void entirely. You can take a look at this example to see how the buy-side imbalance was completely filled over the course of time. The great thing about trading liquidity voids is that they are present across all time frames, and so they can be used across all these time frames. The implication of this is that traders of all trading styles can hope to benefit from it. Intraday traders can go down to 15-minute chart to trade them. Scalpers can even go as far down as 1-minute chart, and swing traders can also take advantage of liquidity voids on the 4-hour and even higher time frames. Now, let's just briefly talk about how to approach our trades to benefit from these voids. If you have understood what liquidity voids are, you may already have an idea of how to trade them. You know that since the void almost always gets filled, your hope is in trading the fill. And how do you trade the fill? Or how do you know when the price is about to reverse to fill the void? So the first thing to look out for when attempting to predict where the price may start the void filling reversal is to look for liquidity zones before the void. These liquidity zones or pools are often in the form of supports and resistances. This is where you can expect the price to reverse from and fill the gap. Another way to spot areas of potential reversal for filling of the void is to look for liquidity zones that have developed after the void. Now, you will find the price going up and down around this zone. However, you can only use this method when the filling of the void does not happen abruptly. That is, the price consolidates for some time, creating a liquidity zone that can be tapped into. Now let's move on to the second concept, which are vacuum blocks. As the word vacuum suggests, there is a complete absence of trading activity. By definition, it refers to a specific area on price chart where rapid price movements has occurred, leaving a noticeable gap or vacuum in the market. Unlike liquidity voids, where there was either a dominant buying or selling pressure, resulting in an imbalance in prices, vacuum blocks are associated with no trading or transaction in between, leading to gaps in the charts. In the price action context, these are called price gaps, and in SMC, it is known as vacuum blocks. Just like liquidity voids, vacuum blocks also represent inefficient price action. These vacuums are crucial in predicting future price movements as they often act as magnets, drawing the price back to these zones for a retest or to fill the gap. Let me explain this. In practical trading, a vacuum block operates by leveraging the market psychology behind sudden price movements. When price rapidly moves away from a certain level, it often leaves behind a region with little or no trading activity. This is a vacuum block. These are formed as a result of any high volatility event or news or even during session openings. Most experienced traders would monitor these areas as they can act as magnets for future price action. So when the price revisits or retests these zones, it can trigger a strong reaction, either continuing the initial trend or reversing it. The price revisits this vacuum block to fill the inefficiency in price action. But keep in mind that not all gaps are filled completely, and some gaps take a lot of time to get filled. Vacuum blocks are also classified into two types based on its formation. These are bullish vacuum blocks and bearish vacuum blocks. A bullish vacuum block is a gap created in price action when price opens way higher than the previous candle. To mark the vacuum block, we have to consider those two candles between which the gap was formed. Then we need to mark the highest point of the first candle and the lowest point in the second candlestick. This will be our bullish vacuum block or simply a gap up. Now, a bearish vacuum block is a gap created in prices when the market opens lower than the previous candle. To mark a bearish vacuum block, we have to consider these two candles between which the gap formation took place. So all we need to do is to mark the low of the first candle and the high of the second candlestick. This will be our bearish vacuum block or simply a gap down. These gaps are formed due to liquidity vacuum, which is directly related to any events. You can see these sorts of gaps forming every now and then in our Indian indices, which is primarily due to overnight sentiments following some global or domestic events or news. Occurrence of such vacuum blocks are comparatively rare in case of forex markets because these markets function almost 24/7, so every news is factored in. Due to this, we might see a lot more liquidity voids getting formed rather than vacuum blocks in forex markets. This is another area where liquidity voids and vacuum blocks are related. Both these areas are formed as a result of some volatile event in the market. Usually, these are related to some news that induces a lot of buying or selling. This increased number of buy or sell orders at any given prices will result in price keeping certain price levels, resulting in a vacuum block in case there is a time delay between the market close and the market open. And in other cases, if this surge in buy and sell interest happens during the market hours, it will result in large candles in the same direction, resulting in an imbalance or a liquidity void. I hope things make sense. Now, if you want to know how to make use of this vacuum block concept to take your trades, you can watch my video on price gaps in my free price action course, or you can wait for the next season of this SMC course. Moving on, vacuum blocks and liquidity voids can be classified into four major categories, depending on where they appear on the chart. And of these four, only two tend to get filled quickly. The others take some time to fill up. These include common liquidity voids and common vacuum blocks, exhaustion liquidity voids and exhaustion vacuum blocks, breakout liquidity voids and breakout vacuum blocks, and finally, we have runaway liquidity voids and runaway vacuum blocks. Let's briefly look into each one of them. Common liquidity voids and common vacuum blocks appear randomly on the chart. Often there is nothing more to their formation on the chart beyond their mere appearance. These are formed at random locations, or in other words, they have no underlying price action meaning in the market, or maybe not something that I know of. But one observation that I have made is that these common voids and blocks are formed within ranges. That is, when the market trades between a certain range, you will come across them. And 80 to 90% of the time, these liquidity voids and vacuum blocks get filled. Now moving to exhaustion liquidity voids and exhaustion vacuum blocks, these happen at the end of the trend. As the name suggests, these get formed when the market loses steam and is nearing an end of a particular trend. And when this happens, the market forms a vacuum block or a liquidity void, indicating a trend reversal. Now talking about breakout liquidity voids and breakout vacuum blocks, as the name suggests, breakout voids and blocks happen when the price breaks out of a support, resistance, or a liquidity zone. After the formation of a breakout vacuum block or a liquidity void, price will most probably return to fill the imbalance and then move in the direction of the breakout. Finally, let's talk about runaway liquidity voids and runaway vacuum blocks. These are considered as continuation voids and blocks because of where they appear on the chart. These happen in a market with an already established trend and they appear in the direction of that trend. Runaway liquidity voids and runaway vacuum blocks don't fill on time as they often serve as continuation of the trend. So these are all the important things that you need to know about liquidity voids and vacuum blocks. So if you have come this far, thank you for watching this video. I hope you have found this video informative. If it was useful, please make sure to like and share this video with your friends and fellow traders. Also, don't forget to hit the subscribe button and turn on the notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. I appreciate your support and I look forward to seeing you in the next episode. Till then, bye.